Welcome to the Global Investor Podcast, a show that focuses on helping foreign investors enter the lucrative U.S. real estate market. Host Charles Carrillo combines decades of real estate investing experience with a professional background in international banking to interview experts in all areas of U.S. real estate investing. Now, here's your host, Charles Carrillo.
Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carrillo. Today we have Christopher Salerno. Chris is the founder of QC Capital. He is a multifamily real estate syndicator who controls 360 units in the Carolinas, worth over $40 million, all within the last 12 months. Chris also hosts the Mindful Multifamily Podcast. So thank you so much for being on the show.
Thank you so much for having me. I'm super excited to be on and add value to all your listeners.
Awesome. That's what we like to hear. So Chris, what's your background prior to starting your current company, QC Capital?
Yeah, I love being asked this question because I grew up in basically in a real estate family. My father was a broker in the state of Florida, and I always, for some reason, had a passion for real estate because it's always different. So my background was single-family real estate sales. From there, very quickly grew a decent-sized team, which then I merged my team with the number one team in the Carolinas and really fell into their operational role. And I was able to make them 46% profitable in 1 year compared to their 3 years of just being stagnant with no growth. And then that's when I felt like I hit my ceiling and I said, I need to start studying commercial. And that's when I fell in love with multifamily investing.
So how did you choose real estate like for your investment vehicle, not just as being on the other side of it?
Great question. So when it comes to that, I chose it because in 2012, multifamily was the strongest asset class out there. And I said, that's a necessity. I said, that's where I need to be, is where it's a necessity. No one can take it away. And that's why I decided to go with multifamily. Right now, I post on my social media a lot, but right now, in my opinion, retail's at a recession. So that's why I'm not in retail, because it's not a necessity. But housing, it will always be a necessity for us.
Right. That's for sure. Yeah. Multifamily people need a place to live, and
that's right.
Retail's got their own challenges, which they definitely will work out. There's so much money in there, but
sure.
It's not as easy. When I speak to people that are commercial investors, in the sense of not commercial multifamily like we are, but commercial as in retail and office space, et cetera. I mean, it's a whole different animal when you're dealing with it. Much longer to lease out properties, much more expensive when it's not leased. You might buy a strip mall with 8 places in it or 10 places in it. We're buying a place with 100, 200 units in it. So the volatility is just minimized dramatically.
Yeah, you're right.
So can you explain the structure of QC Capital? I know you guys are growing. You have a new acquisitions person you just brought on?
Yeah, so we have a new acquisitions person we just brought on. We're super excited to have him on. He used to work for Marcus and Millichap. Before that, he worked for Caldwell Banker, so he has a ton of real estate experience. He's a hungry guy looking to acquire and find new deals, so we're super excited to have him on. We do have an underwriter. We just haven't announced his name yet, and he's been working for us about 6 months. But we have not did any announcements on him. We're keeping that under the radar because he works for a large company in the multifamily space. So once we're ready, we'll bring him on.
Wait, so how do you guys, because you handle mostly capital raising, is that correct for your?
Yeah, so that's my main goal is capital raising, investor relations. It was acquisitions, but I'm still very heavily on the acquisition side still.
Yeah. It's very difficult to do both of those.
It is. So I'm slowly releasing it because I'm big about relationships and adding value. And the reason why I wanted to have an acquisition specialist who used to be a broker is because he understands the ins and outs. And he will be able to build that relationship stronger with the brokers for multifamily because he used to be a multifamily broker. So.
Yeah, he can cement those relationships, and then
Correct.
You can spend your time. And especially he knows exactly what they want to hear since he was on that side before. How do you handle deal flow and underwriting your team? Everything goes, so now it goes through the acquisitions person, then down to your underwriter, and you guys review it that way. Do you have anything special?
Great question. So we have a specific criteria that we follow when it comes to just preliminary research of our acquisitions or any deal flow that comes across our desk. And once it hits that preliminary criteria, our acquisition specialist will then input it into our deal flow list. Because we don't live in my acquisition specialist lives in Charlotte, my underwriter is in the Texas area. Because we all don't live under one roof or have one roof just yet, we use a Google Drive sheet, which is very beneficial because we all can see who edits it and what they edit. So our acquisition specialist puts it in the Google Drive sheet. We have a documents tab where it has the OM, rent roll, T12, taxes, anything that comes with that property goes in the documents tab. And then our underwriter goes ahead and underwrites that property from those documents and inputs the data in there. Once the data's in there, just on an extremely conservative standpoint, if it meets our criteria, then we'll all go ahead and have a Zoom call just like this to discuss each property and when the offers are due, and to ensure that we've contacted the property manager and ensure we contacted our lender and our insurance guy to make sure our numbers are correct, our performance correct, and we can move forward.
So when you guys are evaluating a deal, let's go into that. Like, what is your criteria? What do you guys are looking for when looking at a deal, and what are stuff that you're going to stay away from?
Yeah, great question. So we focus over 100 units, primarily B assets. We are looking into A and A minus assets in the large cities and MSA. So we're looking heavily focused on Raleigh, Charlotte, Greenville, South Carolina, Charleston, Atlanta, Georgia, Orlando, and Dallas. Those are our major markets that we're focusing on, and the MSA. So that's what that's our basic criteria right there when it comes to it. It has to be in a great location. We always look for a Starbucks, a Target, a Chick-fil-A around that location, depending on what state or city it's in, because those are some large companies that have done a ton of research when putting a franchise out there. So
yeah, they've done more research than we'll ever do. And
correct. So I'm gonna hop on their back a little bit.
Whole Foods is another one that we look for as well. I'm not sure if you mentioned that, but that's the same thing. Starbucks, Whole Foods.
Yeah, we look at Whole Foods, Starbucks, and Chick-fil-A. We were looking at Earth Fare, but unfortunately, like I said, with retail, Earth Fare is closing its doors, which is like a Whole Foods here in the Carolinas. So, but yeah, those are our major retailers we look for. Also Publix and Harris Teeter, especially here in the Carolinas, because those are the little higher end grocery stores. So that will tell us the demographic in the area.
Yeah, Publix definitely for being in Florida, for where you're looking in Orlando, or really anywhere in Florida. So when you're you guys have your team together, your team is kind of spread out a little bit, where you have some of your underwriters in Texas. How important is having the team with how you guys are syndicating now? I mean, would it even be possible with what you guys are doing if you didn't have your team in place?
It would be very, very, very hard. And you can hear me stutter on that. It'd be very hard because right now we're analyzing over 12 deals. And I used to do that all by myself, underwrite, analyze the deals, tour the properties, talk to the brokers. And it was a lot on top of marketing all over social media and investor relations. So it's definitely been some weight lifted off my shoulder. But I am a perfectionist, so I want to make sure that the relationships are being creative and being structured properly and strongly with the brokers. So I'm working very close with him to ensure that happens, and making sure with our underwriter that we are underwriting conservatively and to ensure that we're hitting our pro forma.
Yeah. One thing I want to circle back to is that you were saying that you guys are looking, obviously, B+, which is a lot of syndicators look for that, but you're also going into the A- A class. First of all, if you could define them as you guys see them for where you are, mainly in Charlotte or in the Carolinas, and can you explain why you're moving into that class? And
yeah, great question. So A class is anywhere year within 10 years or within 12 to 13 years. Everyone has a different when it comes to it. But A class for us is anywhere from 10 to 12 years newer in newer construction. B class is after that. We really don't like to go anything after 1990. So we like to stay in the 1990s and 2000s when it comes to it. The reason why we're going for A class, and I'm seeing this a lot, and I'm seeing a lot of operators that are not experienced in this space that are doing this, which worries me for them, is that they're going ahead and purchasing properties at $200 a door, and they're having renovation budgets per doors at like $10,000. So that leaves you at like $210 a door. But you can go down the street, and that's a 90s type of product, but you can go down the street and buy a 2010, 2015 type of product for $215, $220 a door. So that right there just doesn't make sense to me, because at the end of the day, when you hold that period, when you hold it for the next 5 years, that newer type of product's going to be worth more, and you'll be able to sell it to a larger institution to pay more than that 90s type of product.
Yeah, the A class, I mean, you'll have people that say B and B plus are institutional, but I think, when you're getting into real A, that's where A minus, A, B plus as well. But in that area, like the A's, that's where you're really having institutional money come in, like life insurance. What we're saying is like life insurance companies coming in that are paying cash for it, that are just setting money aside that need to make, 4% or whatever.
Oh yeah.
And it's like their exit strategy for that. So it's amazing how you said that between, it's so expensive because there's so many people now trying to do the value add in the B's, and obviously the Carolinas and Charlotte being such a big market that people are paying that much over what it might be, you know what I mean? It might even be cheaper.
Oh, I agree. Yeah, and if you look, like we're analyzing a couple deals right now that are a lot of them are over 2000 actually, but there's some that are 2005 to 2012 that we're analyzing, and they still need value add. From 2000 or 2020, we feel that anything that was 2005 2010 is outdated. So there still needs some value add to those particular properties, but they are newer type of properties, but maybe not a heavy lift from a 7 to 10,000 per unit, but you can do a 2 to 5,000 per unit and still walk away with a increase of 100 to 200 per unit for rent increases.
What if you say people are purchasing something for 200, 210, 215 out the door after their renovation, what is something like that normally renting for?
Great question. Yeah, that normally runs for. I saw that when speaking about that, we're seeing that a lot in Raleigh, is around that 200 a door. We haven't seen that for B assets here in Charlotte just yet, but in Raleigh, that's what we're seeing. And they're renting anywhere from a 2-bedroom around 1,300 to 1,500. 3 bedrooms around 14 to 17, and 1 bedrooms are around 1,100 to 1,300, in that ballpark.
Wow. Okay. Yeah. So it's, all right. Wow. It's a little lower than, you know what I mean? It's, is that before or that's after your value add?
Yeah,
Okay.
that's all depends. That would be in my opinion after the value add. That's what it would be in that ballpark.
Wow. Okay.
Yeah.
So you guys are very competitive up there in your market.
Oh, we're extremely competitive. How competitive is that? No matter what, you have to put hard money down, and it has to be. If you don't put a minimum of 200,000 to 300,000 hard, then it's going to be very difficult for you.
Can you explain that?
Yeah, great question. Yeah, that's great, because a lot of people don't understand what hard money is. So hard money is your earnest money that you're putting down. And what hard money means is it is non-refundable. Now, you can have it non-refundable day one, or you can have it non-refundable after your due diligence period. If you really want the deal, you're going to have to do it day one. And that's what we do. We do hard money day one. One thing I dislike about putting hard money down is that if or anything that comes up during your due diligence, you really limit yourself to negotiation for a retrade, because the seller already has your hard money. So it's going to be extremely hard to negotiate for a retrade. So before you put hard money down, make sure you walk that property. If you have to walk it multiple times with the broker or have your contractor out there, do so, because if you're just going to throw down hard money, you're going to take a big risk. If something large comes up and the seller's not willing to do it, you're going to take a big risk, and it can hurt you.
Right. Yeah. So the hard money, just for listeners, the hard money you'll also see is, like he said, earnest money, which is like you'll see in blogs as EMD, earnest money deposit. And then you'll also see the other thing you're mentioning as well in regards to
when it comes to limiting your negotiation.
Yeah. So retrading is just doing the renegotiation. It's a industry term for that.
Yeah. So if something comes up during your due diligence and you're like, okay, well, I didn't know about this, so I'm going to go back to the seller and try to knock 100,000 off, or try to get them to cover for this certain expense. It's much more difficult to go back to them, because they have your non-refundable deposit of a couple $100,000. So they're like, okay, well, you know, go ahead and walk. I got your money. But as speaking with brokers and coming from a brokerage background, if you have 500 to $1 million down, which I have seen before, I've lost out on deals when they put 1.2 down hard day one. You're going to lawyer up. If something goes south, you're going to lawyer up, and those brokers and sellers know that. So the sweet spot is between 2 to 500,000.
Okay. So that's like 1%, 2% of your purchase price, probably?
Yes.
Okay. All right, cool. So it's just pretty normal, but it's just not normal that it goes hard so fast.
Yeah, I know.
So where do you see where you are right now, where we are in the market cycle, and especially in regards to the Carolinas? What do you think you see for the next 12, 24 months?
I love that. Great question. Great question. And I love it when I get asked that. One of the reasons why I got into multifamily, and for the listeners, if you remember right when we started this podcast, I said it's a necessity. So housing is a necessity. We need it. I just posted an article on my social media saying more people are renting. I woke up this morning and had an investor text me the article saying you're going to love this, and more people are renting. No one wants to own a home now. That's not the American dream. The American dream is to become really financially free and not live in debt. So more people are renting now so they can check out different cities, and jobs are transferring them. So where I see the market for multifamily in the next 12 to 24 months is still very, very strong because it's a necessity. Yes, we may have a dip, but look at 08, 2012. That was a single family recession. And between that recession, multifamily went from 96 occupancy to 92% occupancy. So it only had a 4% vacancy before, and then right when it happened, it had a 6% vacancy. And even during that time, A class was strong, B class was strong. Everyone needs a place to live, so it's not going away. Retail, in my opinion, is going away. I'm seeing it more and more. Macy's is closing stores. I'm seeing a ton of people close down shop just because Amazon took a big hit with all of them. Everyone's shopping online. You have to deliver if you're a company now, but online shopping's where it's at. No one wants to go in stores. The only store or mall that will only be open in the future will be luxury stores, because people still want to go and try on a Louis Vuitton purse, or they want to feel Louis Vuitton or Tiffany diamonds. They want to see that and feel that. So the luxury malls and stores will survive, in my opinion, but all the other ones, we're in a retail recession. But multifamily, very strong because it's a necessity.
Yeah, for sure. I've also seen that Best Buy is having smaller stores now where you can actually pick up your properties and stuff, or pick up your items and your products much smaller. So
I'd love to pick up my properties. It's that easy. Just go and pick them up.
So you can it's just a different way of people. Not the whole big box anymore. So I don't know, imagine what products they have in there. I imagine it's very high-end products. And then you can also just pick up you can pick up whatever you're buying from there.
I went in Best Buy to look for a certain thing for our videographer and for the videos that I do, and I saw the price. I went on Amazon right in person and saw it $10 cheaper, and it will be delivered tomorrow. And I just bought it right off Amazon. Yeah. So yeah, I mean that's you have to adapt with change. Mm-hmm. I don't watch TV much, but when I do, I watch it for commercials, and the reason why is because I want to see how they market to people. And I noticed that a pizza company that never delivered started delivering now, because you just have to do that. You have to market, you have to move with the market, or your business is going to go out, just like Macy's shutting down shop.
Yeah, it's amazing. Places that never would deliver now do deliver, or have the access to it with all this, Uber Eats and all delivered in. So it's such a super niche that's growing.
That's right.
And like you were saying before with multifamily, I also think that people just don't want to be tied down. Yep. We heard from years back, our parents, our grandparents had one job or two jobs, and now we're going to have 7 or 8 or whatever it might be. And people younger than us probably more. So they don't want to be tied down if they're working in the city for 2 years. You know what I mean?
You're right.
And have to sell that house, do that. And they also want all the amenities that come with it. Like you said, how close can I walk to a Starbucks? Can I walk to a Publix or to a supermarket? Can I, so that's awesome. Right. Yeah, those are very important things to look for when you're looking at property. So I know you do a lot on social media. You do a lot of conferences. I know I'm seeing you in a couple of weeks for a conference out in Colorado.
Yes.
And what do you see when you're speaking to new investors? What do you suggest them to do if they ask you how they should get started? Maybe it's not syndicating, because that's a pretty big leap for someone to take money from someone that's never done it before.
Oh yeah, and don't do
Yeah,
that. I mean, get your experience first. That's the biggest thing, is educating yourself. I educated myself. It took me like before I even got into multifamily syndication, it's 7-8 months of education of I didn't even know what syndication was. I was like, what is syndication? But it took me around 7 to 8 months to really get the grasp of it. And coming from a real estate background, I'm a big believer, and anything you do, I'm a big believer in following how the military trains our soldiers. And the first week of going into the military, what they do is it's called Hell Week, and they tear down your brain mentally and build it back up into a soldier. So I'm a big believer in that, and that's why when I left single family and was making that transition, I tore my brain down from the single family industry lingo and all that, and I built it back up into the multifamily industry to help educate me in multifamily. And before I even got into it, I was listening podcasts like yours. I was watching YouTube videos. I was reading books to understand everything, because it is a big business. It's a scary business for a lot of people. And then I decided to find a mentor and a coach to limit my mistakes and to guide me through the correct paths. So that's extremely important.
Yeah, no, for sure. What do you see with investors? Let's say they've already started, and maybe you have deals that get sent. I know I get deals all day long. They get sent to me to look over, just see what people are trying to raise money for, or people are looking to buy. What mistakes do you see people making in this? Let's say, for instance, now and then also in this market cycle?
Yeah, that's a great question. I'm seeing it more and more. Mistakes people are making is not understanding the SEC regulations, and that they are no joke to play around with. So I see that more and more is not understanding that. So I would highly recommend, if you don't understand it, get with an attorney at a conference, speak to them over the phone, start reading books on it, start listening to podcasts, start educating yourself on it, because that's the most important aspect of it, in my opinion, is you want to make sure you're doing everything properly, and you're not stepping those boundaries. So I see that as a big mistake. Sometimes, I get a friend request on LinkedIn, and every time someone friend requests me, I reach out to them, and they have to have mutual friends in common. If we don't have a lot of mutual friends in common, I won't accept you, but I'll reach out to them, try to connect with them over email and then the phone if it will be very beneficial for the both of us. But I get some messages that we have tons of friends in common, so I'm assuming they're well grasped in the industry, and they're trying to sell me a deal over LinkedIn, and I'm like, well, what type of deal? I mean, you're just trying to sell a deal, or do you even have an SEC attorney? What proper steps are you taking? And sometimes I try to help educate them and say, look, you need to go ahead and consult an attorney, because I don't want you to get in trouble, so I see that a lot, and it's happening more and more as the syndication name is being thrown around, and that it's getting more familiar with everybody.
Yeah, no, that's for sure. And just to clarify for listeners as footnotes is, so with raising money through syndications, there's two different exemptions, as we say. There's one for certain investors that are high net worth or high income, called accredited investors, and there's one that is just like, we're talking, Chris and I are friends, we have a prior relationship. If we want to raise money through that, we could, but I can't go if we have a deal like that and put it onto Facebook.
Correct.
And I can't put it onto LinkedIn. I can't just contact a random guy online and ask him to invest. And people are doing it today, and with so much buzz around syndication, it's even worse. That's a thing that I feel is probably one of the biggest ones that I don't hear when I interview people. They usually are saying about the different market cycle and stuff like that. But this is something, and just to let you know, if one of your partners, you're on a deal with like 7 or 8 people, and one person does it, they look at everybody. It's not, so you have to know exactly who you're partnering with and make sure that they understand what's going on. And also, they have a very good attorney that's reiterating this to you and saying.
And getting into this space, save some money aside, because these attorneys not cheap. I mean, I had a attorney charge me $1,000 for 12 questions. So they are not cheap. So be sure you have a nice little safety cushion set aside for if anything happens like this. And I know as you grow your company, you may not have a lot of funds, and that happens, but you have to make smart decisions then. And you have to educate yourself with those with that journey that you go down, so no issues arise. And then when you grow a large company, like we discussed before this, you can have people on staff. So if any issue comes up.
Yeah, the other thing too is that my SEC attorney that I work with mainly, he'll actually come on to the deals too. So once you have a track record, if you don't have to put out money on future deals, and you can also bring them on as a general partner, and you can also give them some equity in the deal. And that saves you on putting upfront money out of your pocket. So there's so many different ways of cutting it, but you're not going to be able to probably on your first time contacting the SEC attorney be like, hey, I've never done this before. I don't do anything.
I want to give you ownership. Yeah.
They'll probably just be like, I'll just take the $15,000. But, but okay, great. Yeah. So I want to, how can people learn more about yourself and QC Capital?
Yeah, thanks. Thank you so much. You can reach out to me at Chris_Salerno_ on Instagram. I'm heavily on social media. If you'd like to join our closed Facebook group to network among like-minded individuals, it's Mindful Multifamily Network. And we also just created an academy, the Mindful Multifamily Academy, to help new syndicators get into the business or investors understand more about syndication. And that's only $199 a month. So
nice.
Also giving away my underwriting template in there.
Awesome. Yeah, that's probably worth it just by itself.
For the template. I know.
Yeah. That's awesome. Yeah, anybody that's getting involved with syndication, they have to learn. With any type of real estate investing, you have to learn exactly what you're doing.
That's right.
Do it yourself before you take money from other people, please.
I agree.
But okay, well, thank you so much for being on the show today, and look forward to touching base with you next couple of weeks when we meet up in Colorado.
I can't wait for it. Thank you so much, and safe travels out there.
Thank you. You too.
Yes, thanks.
Hi, guys. This is Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in investing in real estate and you don't know where to begin, set up a free 15-minute strategy call with me at schedulecharles.com. That's schedulecharles.com.
Thank you for listening to the Global Investor Podcast. If you like the show, be sure to subscribe on iTunes or Google Play to get new weekly episodes. For more resources and to receive our newsletter, please visit globalinvestorpodcast.com. And don't forget to join us next week for another episode.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Harborside Partners Incorporated exclusively.